going to go back to what I said several times yesterday, which is you've got to take a shareholder's perspective or think like an investor when you think synergies. So value creation is the best measure of synergies. And we talked about we're going to use the DCF approach. It's going to be much more, this is going to be a simple exercise for you now that you've gone through the complexities of DCF. The buyer should be able to create value from this acquisition that didn't exist before, for you, the buyer, or for the target. They're creating new value from this acquisition. Thinking like the investor is going to eliminate a lot of mistakes that you'll make with the synergy exercise. Okay? What does it mean to think like an investor? Well, investors make decisions based on future benefits, not the past. It's not about the past of the target. It's about the future. Okay? They pay attention to cash flows rather than accounting profits. Okay, so here's that equation again. Earnings plus non-cash charges or depreciation minus investments. CapEx, changes in net working capital. The more you risk, the more you should create a return. And that's going to affect how you value the synergies. Just like DCF, you're going to base the value on future expectations rather than undiscounted future, meaning you want to apply some type of discount rate to discount those future benefits back to time zero. And you want to think in terms of either or. What does that mean? Either this or that. Meaning they should create alternatives for you. Remember we talked yesterday about in-place synergies and contingent synergies. We'll get back to that in a second. We've talked about information advantages. You should be seeking information advantages in the synergies. What can you create? And we're going to categorize about 5 different types of in-place synergies that you can capture. How can you identify elements of value that others cannot? Doing that in the due diligence period, doing that with real thought towards integration and what could be true, credible synergies versus hype, which a lot of market has to digest a lot of hype on synergies. And investors diversify. So think like an investor is my advice to you when you're thinking about synergies. It's the centerpiece of M&A. You should be winning the battle of M&A over private equity because of synergies for the most part. You should be winning. You should be beating them because the value you can add over on top of the base value of a business, the synergy value should carry you to the ability to create more value out of that transaction than a private equity firm. Private equity is winning a lot of battles right now. And I think, my opinion is, the reason they're winning it is they've mastered all of these things we've been talking about yesterday and today, and they're using that to their advantage. You can level the playing field, and you should win against private equity. You should be able to win. So the deal price that you pay should be less than the value of the target standalone plus the value of the synergies. They're going to help you, just valuing the synergies is going to help shape your understanding of them. Sourcing, where are they coming from? How certain are they? How long will that synergy last? And what's the magnitude of that synergy? and it should become the foundation for how you set up integration. Because as we talked about, that's what the task force teams are doing. They're capturing those synergies for you. And you want to capture the low-hanging fruit synergies first, and then move out on that spectrum towards the more risky synergies. And we're going to evaluate the risk of the synergies. You're going to assign a risk factor value to each synergy you identify. So back to what we talked about yesterday, two types of synergies. In-place synergies, which means that their payoff is fairly predictable. There are 5 different types of in-place synergies. And then there are real option synergies, which basically is like optionality. You're creating more options that you didn't have without this acquisition. We'll unpack that again in a second. So the value of the synergies is equal to the value of the in-place synergies, or the more certain synergies, and the less certain, or real option synergies. Okay? DCF is the best approach to use in valuing synergies. Here is your equation. So you've got the free cash flow to that time period, and you may have a synergy that only lasts 1 year. You may have a synergy that goes into perpetuity, and therefore you need to use the terminal value in the calculation of that synergy. And it's 1 divided by WACC, okay? We're going to give some caveat to that, but WACC is, as we said, it's the blended opportunity cost to all investors. Not all synergies deserve WACC. You have different levels of risk depending on the riskiness of that synergy. Okay? There's a speculation that synergy value can be created by improvements in WACC. It's somewhat speculative. There's more certainty around a cost synergy or a revenue synergy than there is a WACC synergy, but there is such a thing as a WACC synergy. Okay? You can have improvements in timing through a synergy. That shows up in the T, meaning you may be able to accelerate some activity closer to time 0. And that can be valuable in and of itself, right? Because we know that because that discount factor, discounting something way out in the 5-year time frame, it's more discounted than more recent. So when you move an activity closer, you actually can create value, right? So let's talk about the different types of in-place synergies. So we have revenue synergies. So the acquirer can sell more products than either of the two firms would have been able to sell independently. Okay, and that's due to cross-selling or cross-branding. This is what they call classic synergies. 1 + 1 = 3. You should be able to create, from your acquisition, you should be thinking right off the bat about what revenue synergies can you create. Okay? Cost reduction synergies are basically reducing overhead as a result of the transaction, or unit cost decline. So we talked about economies of scale yesterday. That's the name of the game here, and this is the most certain type of synergy. Reducing costs from greater purchasing power, supply chain consolidation, capacity utilization, improvements in logistics, distribution, closing a target's headquarters, or some kind of tech transfer. That's all examples of what can be economies of scale. Okay. Asset reduction synergy. That's the third type of in-place synergy. That you may be able to dispose of idle assets that you can liquidate those assets and put those back to use into another type of investment that you need to make. vacant real estate, redundant headquarter buildings, unused plant capacity, excess inventories, cash balances. Those are examples of asset synergies. Okay? These are typically one-time events. You're not going to have a terminal value to those. Tax reduction synergies. So that could come from an increase in depreciation tax shields. How does that happen? And what does that mean? What is a depreciation tax shield? So when you buy a company, you're going to have to, the buyer is going to have to adjust the assets. They're going to buy them, and they may have been depreciated, but they have to get a calculation of the assets after the close, and those assets are going to be basically adjusted in what's called a step-up basis in the assets. And that's a IRS mandate. And as those assets get reevaluated, that can create new depreciation, right? Because you're now depreciating those assets again. And depreciation is an expense that comes out before income taxes. So it actually reduces your profitability. Your pre-tax income can be less because of greater depreciation. It sounds bad, but it actually is. Remember, depreciation is a non-cash charge. You're not actually writing those checks. So you can reduce your taxes from acquisitions, which is you're saving money. You're putting more money into your business than you're giving to Uncle Sam. The second type of tax reduction is the target has a lot of NOLs or net operating losses that then transfer to you, and you can use those against your income tax liability. The final one, so there's 5 different types of synergies that are in place or more certain synergies, but this is the most speculative one, and one that I don't really believe in totally, but reduction of WACC as a result. So if a WACC reduces, what happens to the value of a company? Getting back to that equation, it increases the value of the company. And WACC can be reduced by basically your ability to take on more debt through this transaction. Let's say you do the transaction and you're able to restructure your balance sheet to where you're able to, maybe because of the cash flows of the target, you now have more debt capacity. And so you do finance this deal with more debt, and you have more debt than you did before. Well, that interest, okay, and the interest expense on your income statement also reduces your pre-tax profit, which means less taxes again to Uncle Sam. But what it also does is it shifts this equation. Think about this equation of WACC. The debt becoming greater, remember when we said the cost of debt is lower. So when you shift this equation to more debt and debt being lower, the WACC goes down, okay? And that's one of, let that sink in for a second. So as you shift more of the capital structure to debt, and the cost of debt is almost always lower, you shift this and lower the WACC because equity is more expensive than debt.
That would be the one synergy that private equity would
Well, and also because a lot, let's say the private equity goal is a lot of times to create a platform and then go through an acquisition spree to grow. They really are big on inorganic growth. They love it. And so they would say, so you're going to be competing with private equity funds that already have a platform in the market you're trying to acquire in. And they're going to say they can create synergies too, because they can cut out costs between two companies that they own. And that's why you see them, they become, a lot of private equity funds are industry specialists, and they're building platforms and add-ons and building it up and then selling it to larger private equity funds.
They do tend to lever it up more with debt once they make the purchase. Right?
Yes. And we've had experiences where we sold a company several years ago to a private equity fund, and they paid a premium for this company, and they levered up the company to do the transaction. They over-levered the company. They underestimated the experience of the owners that sold this company. They let them go. They didn't, in terms of integration, there was no integration because they didn't have another company yet in this market, but they let the owners go, and these owners really knew a lot about how this business model worked. And within a year, this company went into bankruptcy because they levered up too much. So, and the company had to be sold at a fraction of what it was purchased for by this private equity fund. So it's mistakes get made all the time in all of these transactions. The second type of financial synergy related to WACC is this insurance theory that says that if you have two cash flow streams and you combine them, that the combination of the two cash flow streams lower the risk of those two cash flows. It's like insurance. Two cash flow streams that combine create lower risk of those two combined. It's an insurance theory because you're layering in two different types of assets, and those combined should lower the risk. Because you have a lower risk, you can borrow more.
Isn't that the same thing you're saying is the reason why I guess why you discount large companies versus small companies? You discount small companies, you're comparing them, and it's kind of the same thing.
I can see what you mean, like the parallel of, you discount the small company discount, it's a greater risk to have a small company. Larger companies have lots of different divisions.
Same kind of logic behind that.
True. So here is this is basically what this part of the theory is saying, that it's not so much that you're moving this debt to capital. You can move this is a leverage curve. You can move it further out on the spectrum. You can actually borrow more because the riskiness of those cash flows is less because you're combining them and they're dissimilar assets. This is speculative, and you don't want to base your case of a deal on these financial synergies, in my opinion. I think revenue synergies, cost synergies, asset reduction, and tax reduction are much more credible than a WACC reduction synergy. But many use it. So let's talk about the real option synergy. So these are more risky, and they're basically saying that you now have, because you've acquired this asset, you have an optionality to your strategy that you didn't have before, and that creates value. So growth options, you now have the ability, you don't have to grow in a certain market, but you have, you have choices in growth now that you didn't have before. Can you think about some examples of that? Let's put some tangible examples that may help frame this up. Growth option examples. Unfortunately, I don't have really great examples. I don't think but can you think of one?
Well, if you do it from a market share perspective, these two companies, say each 15% of the market, and they combine and have more, then they may have more pricing power and push others out, so they can grow because of that aspect.
Yeah, more economies of scale.
Economies of scale, so they can make money cheaper at lower prices within these certain smaller players that can't compete. So start moving out of those areas.
That's good. Who else? I have down, you now have information you didn't have before, and as a result, you have a different decision on investment that you now, maybe you need to move quicker into investing in a certain market. Because you've acquired an asset, you now have information from that target that you never would have known, and as a result, you realize there's a time factor of moving into growing in a certain place that you didn't know you needed to move that quickly. So therefore you have a new option here that you need to invest in to grow. R&D is one example that is used. Mineral reserves, that you now have access to mineral reserves. I don't think they're great examples.
And Tom's a good one. I mean, size opens up channels of distribution that you couldn't get in a smaller size.
So having you're talking about your suppliers, that if you acquire a company, it's really about acquiring certain suppliers for Tom, and that opens up new markets, new growth options. Basically what this is saying is, because of the acquisition, we're talking about synergies here. You now have a synergy option to grow in maybe a different path of growth or a different time frame of growth that you didn't have before.
Right. It's interesting, since you require a certain amount of size. Right?
Yes.
So you gotta have that size, or you don't even get the choice.
Right. Exit options. You now have an option to exit sooner, or maybe delay an exit out of a market or business because of this acquisition. So basically, these are creating options. These types of synergies are creating options you did not have before. Options to defer. You could have patience on developing a new technology or entering a new market or some other risky action. Can you give me an example of an option to defer? Just waiting, waiting on, maybe you wait instead of investing now into some R&D or new project.
Pharma does it when they buy it. Maybe a biotech company whose drug or compound is a little further along in the pipeline, and now you don't have to go through some expensive FDA process on the one that you're maybe a little earlier in trials on, right?
So you've acquired a company that's already gone through that investment, and now you don't have to spend that money.
Or at least you don't have to spend it now, right? You
Don't have to spend it now.
that trial.
Okay. Options to alter operating scale, or options to switch, mixing up inputs. Now maybe you bought a company that has access to certain raw materials that you didn't have access to or knowledge how to use those effectively. And so now it's putting that to use, and maybe you can lower your cost of production, or it improves the performance of a product. So this is something you really have to think through, but they're creating real options. Okay, so I want you to think about the in place and the optional synergies. Everything is after tax. When you're valuing the synergy, everything is after tax. Okay, you do want to account for inflation. How do you choose the discount rate? So what we say here is you start with WACC, and then you decide off of that. That's the center point. And you say, how risky is this synergy? Okay? This is just like valuing cash flows. You're going to say, okay, let's say it's a cost synergy that you're certain of. You know you can extract value out of this synergy, and it's a certain thing. WACC is going to be discounting that too high. It's going to create a lower value than you really need to create. So in that case, something that's a sure bet, you want to discount that synergy at a risk-free rate, which we said is what? A 20-year treasury. Okay? If it is as risky, if the cash flow is as risky as EBIT, so and remember EBIT is where we start to calculate to get to the free cash flow. Then you can use cost of debt to calculate that synergy. If it's as risky as free cash flow, you would use WACC, because you're coming down, you're increasing the level of risk it's easier to get profitability at an EBIT level than it is to a free cash flow level. And if it's as risky as dividends, getting to dividends, then you would assign a cost of equity type calculation to it. Pretty basic. Here's the equation. This is actually an equation that says that you can value, when you're valuing synergies, you can aggregate them or disaggregate them. So in other words, you can value the company without synergies and then add in the synergies. Here, you can combine them. It should reach the same number. When we think the best approach is, I think it's always best to create separate, independent valuation of the company and then value the synergies separate, because you can look at each and how they're contributing to the total value of the company. Here's the purchase price you're going to pay as the acquirer. The value of the target standalone, plus the value of the in-place synergies, plus the value of the contingent synergies. And then you need to adjust for WACC, right? As this company is now a part of your operations. So,
do you typically pay the other company your synergies that you're getting?
Okay, that was brought up yesterday, and I think some folks were surprised that often that can be put on the table. Synergies can be put on the table as something to trade. No buyer wants that. No buyer wants to have to trade synergies. And you can fight it off pretty easily, I think. But you need to know that that's within the norms of the M&A world, that can be put on the table. Especially if the seller, if the ownership team or the management team of the seller is going to be a part of your company going forward. If they're helping you capture these synergies, and they know about, if they have the knowledge and how to get there and help you capture them, then...
But if they're selling and exiting, they're like retiring or something like that, they're not going to realize those synergies.
I think it's a harder battle for them. But I told the example of our deal. We're selling a company that closed this afternoon, by the way. Very sorry about that. It's done. As of an hour ago. We started this in July of 2015. So for us, it's a journey with a client. And this company, I can't say who it is yet because the buyer has to give me that authority, and they haven't given me that yet. But it really is a tragic story, and it's really touching what happened to this family and why they decided to sell. So it's kind of mixed. I always have kind of mixed emotions. I mean, I'm always excited about the close, but in this case, this guy's been through a lot, and you know, he built this company and he's done great things with it. So you know, I'm hoping great things for their family. Where were we here? We're talking about trading synergies. In this deal that we just finished, the buyer, I brought that up. Well, because they were being really tough in negotiations on the valuation, and I actually took our valuation work and we had a conference call. I walked them through how I came up with the valuation, and then I said, and the synergies are what we haven't done yet. So tell us how you're thinking about synergies. And it was just dead silent. They did not want to talk about synergies. And for you guys, be prepared for that. I think that's the best way. You need to be prepared for the potential that the seller may say, and especially if you need them. And in integration purposes, you may need them. We talked about empowering that, keeping them in decision-making authority, right? That could become more of an issue in that case, right? So I want us to discuss, let's bring this back to, we're going to wrap up the day, bringing synergies back.
Question.
Yes.
If a synergy within your corporation, say if you have a division that enables another division to succeed, okay, they're kind of codependent somewhat, and that could be looked on as a synergy or a a liability, I suppose. I mean,
And are you talking about a seller?
well, I'm just kind of looking at a valuation situation
Just
right now.
valuing a company?
Yeah.
That has two divisions, and the divisions are dependent on each other for value.
One division, which is a profitable division,
Okay?
becomes more enabled because of a
Yes, we've had that
supportive
situation.
division.
Yeah.
Okay. Maybe one's a contracting type division, they support one another.
Do they have different shareholder bases?
No.
Okay, that's good. Because often the way that's valued is the dependent division becomes less valuable than the independent.
Right.
And we actually had a case years ago where we sold a company and they had two divisions. One was dependent on the other, and they had separate shareholders. It was one company in the eyes of the market, but two different sets of shareholders. And this group didn't get as much, and it was hard to rationalize, but it's real.
I would almost say they were somewhat codependent.
Okay?
So is that should that become a discount to the valuation?
Not if you sell it as one company.
Okay.
If you break it up, then you're going to lose some value, right? Because there's more risk in that.
The risk
you need to
factor.
market that as one,
Yeah.
most likely. Okay? Good, that's a good question. Let's talk about Mercury. What synergies might exist?
Contract manufacturers, maybe consolidate some of that, save some of the, I think they had about 80 people, each of them had about 80 people in China that they monitoring
Right.
production, some of there's also synergies there.
Okay. So,
Things we don't know about, the design people, the creative people behind the new shoe products and so on. Maybe, we don't know that.
and that could be what type of synergy? Of these
Talent,
categories.
Talent of the people, creative people in the new company as well.
Could create an options, thinking of an option type synergies.
I'm thinking of the fact that, every business people is the most important thing. And if Mercury was successful, so they may have, I guess they'll learn about that, maybe aren't they, about the creativeness of it. It seems to me that there's a lot of creativity required in this shoe design.
Right. So think about these, like as you're thinking about the synergies, what synergies, think about the categories we just talked about. You've got them in your notebooks. You've got those 5 different types of in-place synergies, and then you've got the optional synergies. Think about those in light of the case and what you know. How might they reduce, if you see some cost synergies? Where? Yes.
I was going to say that, there's maybe some duplication in the channels, customer channels, where Mercury has had success with the men's footwear was, through sporting goods stores, which was really similar to some of the same outlets, the non-traditional outlets that
Active Gear.
Active Gear. And so I'm wondering if, from just a sales presentation standpoint, if that would generate some synergies on the sales side.
Okay.
Elimination of duplication.
Yep. What did Mercury, look at table 1 in the case. Early in the case, what was